Hello and welcome to Money, Me and COVID-19, where we meet with leaders from the worlds of finance, business, investing and politics to try and understand the full impact of this global pandemic and what we can do to try and survive and then thrive in the aftermath. My guest today combines a 20-year background in the European banking sector, including major players like NM Rothschild, Dresdner Kleinwort Wasserstein, and JP Morgan Cassano. He then actually migrated to work for one of his clients, a major property group called M7, and then from there into his latest role as managing director of the world's first stock market for commercial property. His name is Roger Clarke. Roger, welcome to the program.
Hello, Graham. Thanks for having me, and hello, everyone.
Yeah, no, I mean, obviously we'll come on to talk about IPSX in a moment, but I think first we just need to talk at a more macro level about this bizarre global pandemic and, of course, the way governments and political leaders have reacted to it with things like lockdown and kind of closing down the markets. I mean, as somebody with your breadth of experience, what's your take on what's been going on these last few months?
Well, of course, it's at times like this when we all realise just how much we rely on real estate. Whether we're using it to work in it, using it to shop in it, using it to live in it. So, I mean, real estate markets have been hugely affected by what's happened in every way imaginable.
Yeah, and so particularly, obviously, you're very focused on the commercial sector. So, one thinks of all the people working from home now. One thinks of the empty shopping malls and things like that. So if we look specifically at commercial, it may be slightly too early to say, but what's your assessment of the impact so far on those parts of the property market?
Well, it's been profound, and I mean, one of the things we've never seen before. I mean, lots of us have spent time looking at previous downturns, recessions, depressions, bear markets, and of course, nothing like this has ever happened before, in the sense it's been global and immediate and complete in terms of the shutdown of economies. So it's been spectacular. I mean, obviously real estate has been affected heavily. Retail just ceased on the one hand, whilst on the other hand, of course, online shopping, a trend that was already there. And we'll come back and talk about that time and time again, I think, today, about how this pandemic has accelerated trends which we'd already seen, but the trend in online shopping has absolutely gone through the roof. So on the one hand, retail closed overnight. On the other hand, it sort of didn't. It changed how it worked. Similarly, offices, as you mentioned, we've all started working from home, or at least those of us that work in offices have all started working from home. And there's been a lot of speculation about whether, is this the end of offices? Do we really need offices? Because I think possibly something that's surprised us all a little bit is actually just how adaptable we've been. And you hear lots of people talking about how they actually think productivity has, if anything, gone up as we've been working at home. And then, of course, there's the leisure side of life, whether it's sports or entertainment, food and beverage, cinemas, and they've been badly decimated. And of course, at the moment, it's still quite worrying, because as long as we here in the UK are sticking to the 2-metre rule, it looks as if some of those types of businesses simply can't work. I mean, you could say to a restaurant owner, you can reopen on the 4th of July, but you can only have 15% of the number of covers in that you usually have. And he'll say to you, do you know what, thanks very much, it's just not worth opening.
Mm. Yeah, no, absolutely. And those kind of rules, which are even, we're still way beyond what the World Health Organization says is okay. So, one of my previous guests has actually mounted a legal challenge against lockdown because it's had such a devastating impact. But I think even some of the facts that are coming into the public domain, Facebook talking about 50% of staff working from home. Anecdotally, one of my neighbors works for BP, who have a huge office down the road here in Sunbury. She's been told she'll be working from home in future, along with a large chunk of people. They're going to sell that head office building. Obviously, they've had the whole kind of oil price thing as well as COVID-19, so it's perhaps an outlier. But I sense that potentially we could be at a tipping point where do we really all want to get on those crowded tube trains and do a 2-hour commute each day? As you say, perhaps we're more productive at home. So Could this be the start of just a different trend in working practice that could ultimately have a big impact on the commercial property sector?
I think so, absolutely. And yet in some ways, I think perhaps less than some people originally thought. What do I mean by that? I mean, there was a survey recently, a CFO survey done by Deloitte, I think it was, that said 98% of CFOs surveyed were considering how to put in place more support and technology so people could work from home. But equally, Cushman's did a survey globally recently of 40,000 workers where 45% of them expected to work from home, but fewer than 10% of them expected to work from home permanently. And I think that's the point, that I think, as you say, work from home 50% of the time. But for the other time, the collaborative moments, the times when you need full team meetings, I think at the moment, for example, I think anecdotally, we have big team meetings where there are 25 of us on a Zoom call. And if you're all on Zoom, I think that works. But at the moment, half of you are sitting around a table having a normal meeting and half of you are on Zoom, half of you might feel a little bit left out. So I think we're still going to need offices, just a little bit less than we used to, and in a slightly different way than we used to. And of course, I think the thing that when it comes to, has the investment market in offices really changed? When you actually talk to people who are planning how this is going to work, when you talk to COOs, talk to HR people, of course, because of social distancing, half the number of people in the office are still going to need the same amount of space because social distancing is probably here to stay. So I think we're going to need better office space, perhaps configured differently, but I'm not sure we're going to need less of it. And you make a very good point, Graham, about the commute. I think what we might see is that rather than having 7,000, 8,000 people working, trying to fit into Barclays head office down at Canary Wharf, what we might actually see is a system of regional hubs, quite large offices, but ones that you can drive to and you don't need to get the train into London to go to.
Yeah, so I think that kind of lifestyle choice is part of all this. People talking about moving out of cities into the country and all that kind of thing. So again, obviously it remains to be seen how much of this actually becomes reality. But I think a lot of people have been surprised at how much they've enjoyed working from home and being more productive. But I do wonder about where this means we're going in terms of commercial property prices, because obviously, as we'll come on to, you're very much in the kind of investment sector of this space. And it sounds to me like at the best, they're going to be trying to make the most of what they've got, but perhaps they're going to be, if anything, somewhat downsizing. So what does all this mean in terms of the direction of commercial property values over the next few years, do you think?
Well, this is an area where one mustn't generalize. I think there are certain types of real estate that may be, at the risk of sounding melodramatic, structurally dead. There are certain types of real estate that might change a little bit. And there are certain types of commercial real estate that actually are going from strength to strength. So let me give some obvious examples. Secondary shopping centres are a type of asset that already was seeing footfall declining, was already seeing it harder and harder to rent space. And that's probably just going to accelerate that decline. On the other hand, I guess things like, Westfield and Stratford, which is, the largest, most valuable shopping centre in the country, will continue to be a must-have location for certain retailers. Obviously, as we've talked about, I think we may see a trend, and this could be really good for some of the regional markets that have, when you look at the UK over the last 5 or 10 years in terms of investment volumes, transactions done in the office space, basically at least half of the value of all real estate transactions done in the UK tends to happen in London. That might start to change. We might actually see the country become less London-centric. And certainly, as we know, we've mentioned online shopping, so anything involved with logistics and faster delivery of goods is highly valuable real estate at the moment and is only getting more so. I mean, as an aside, so far this year in 2020 to date, Amazon have taken 23% of all of the industrial space on offer in the UK that's been taken so far. Amazon need more and more and more space. And if you have something that Amazon want, that's just going to get more valuable. But also, we've seen things like social housing and primary health property, doctors' surgeries. Those REITs in the UK, which are listed and specialise in those types of property, are trading at higher share prices today than they were pre-lockdown. So some of it looks good.
Okay, but I think at the risk of doing a Jeremy Paxman on you, in one of your recent interviews, you mentioned that the property market, a bit like the stock market, tends to overcorrect in a downturn. So it goes down further than perhaps logic or reason would suggest, because most markets are driven by emotions like greed and fear. So are we potentially going to see a jolt downwards followed by some kind of potential recovery, or how do you see that panning out over the next couple of years?
Yeah, I think that we see an interesting disconnect, and we always have, by the way, between the direct property markets and the listed property markets. I'm always perplexed when some people say to me, well, real estate is less risky than direct real estate is less risky than listed real estate because its value doesn't change. And I say, well, surely it does. I mean, surely, like any asset, its value could be changing on a daily basis. You're confusing a lack of risk with a lack of transparency. So, I mean, what we always see in listed markets is they react much faster and often more violently. And I think what was interesting going through the initial reaction in markets to lockdown, to be precise, pre-lockdown, during March, when all markets fell really fast, it was interesting that, I'm going to generalize a little bit, but all real estate fell dramatically in line with the wider stock markets. And of course, that's not good. You don't buy real estate to get market tracking performance. What we fairly quickly then saw though was that the real estate where you could actually look through into who the tenants were and form a view as whether they were going to pay rent, and begin to form a view as to whether those rental streams were robust and secure and might even grow in coming years. Those sort of shares started to recover much more quickly, whilst the traditional, larger, diversified, slightly opaque companies languished. And I think this goes to an old adage that commercial real estate is just a late cycle play on GDP. Now, if we expect GDP to fall, we obviously expect real estate to fall. But I think in modern capital markets, we see much more granularity. Rather than it being a case of deciding whether to buy British land or land securities to get your real estate exposure, you can now actually pick whether you want to be in student or supermarkets, property, logistics, London office developers. So, you can actually choose where you want to go now. So I think that allows price discovery to be quick and dramatic, but it allows it to diverge more than it used to in previous downturns.
Oh, it's interesting. I mean, you mentioned you talk about REITs, real estate investment trusts. We've got those on various sectors. We've got investment funds that specialize in property. We've got direct companies that own shopping malls, etc. So it sort of begs the question: why does the world need a stock market for property on top of all these other ways into the sector?
Yeah, no, it's a great question, and I'm really glad you asked it, because I mean, going back, touching on a point I made a moment ago, part of the answer to that is that in European markets in particular, here in the UK especially, listed real estate today is less than 2% of the whole stock market. The market cap of Unilever is bigger than the whole of the listed real estate sector. Now, part of the problem there is relevance. Increasingly in a post-MiFID II world, buy-side investors, institutional investors, are doing their own research. If you're BlackRock or Fidelity or M&G these days, it's more important to get your call on Unilever right than it is to pay any attention to real estate. So you may find that people will think about whether to invest into SEGRO or British Land, but the smaller companies, some of those that are maybe sub 500 million market caps, some of those actually can provide a lot of outperformance, but certainly the kind of focus that allows you to choose what to buy into. They're irrelevant. They don't get followed. They're illiquid as a result. And the whole sector gets pulled around by equity market beta by market noise. Now, we say that if you have a dedicated stock exchange for property where individual companies or very concentrated portfolios are being listed on an exchange for people who really want to come there and buy real estate, you won't get this equity noise. I'll give you an example. You know, in the last couple of weeks, we've seen a couple of very dramatic market movements on the basis of surprising financial data. I always used to use the example of how you don't want to get pulled around by non-farm payrolls. And as if on cue, sort of 10 days ago, non-farm payrolls came in at a 10 million beat ahead of Wall Street's expectations, which made markets go haywire, not surprisingly. Equally, on the back of that, last week, markets had a little correction, and the VIX index in Chicago, the volatility index, went up from 25 to 47 in the space of a couple of days. It's signifying a lot of fear. Now, those movements will have a huge effect on the share price of British Land, but they don't actually change the value of something like the cheese grater, which was until recently a large proportion of the value of British Land's balance sheet. So what we're saying, our proposition is, take these big pieces of real estate away from the broader stock market and put them on their dedicated market, and they'll trade like real estate, not like index tracking shares.
Okay, so if I'm an investor with some interest in this sector, what can I now do, because this stock exchange exists, that I couldn't do before?
Well, we're about to launch. Our first IPOs are coming in sort of August, September. We should have 3 or 4 coming along then. So today, you need to be patient. But what we will be providing people with, importantly, is control. And control, often when you hear people talk about that in the context of listed companies, they're thinking, you know, I need to own more than 50% of it. I need to own the whole asset. That's not what I mean. I mean, we're providing people with control over exactly what they buy. So if you buy shares in a company like Land Securities, you might know they've got a lot of assets in Victoria. You might know that they own a big chunk of Blue Water. You might even know that they own the Piccadilly Lights. But I bet you struggle to name more than 5 or 6 things that they own after that. What we're offering, however, is the control to decide exactly what you buy. You build your own portfolio by buying a bit of that, a bit of that, a bit of that, a bit of that. You also have control over how much this is going to cost you, because what a lot of the potential investors we speak to are doing to get their real estate exposure today is being limited partners, LPs in some of the bigger private equity funds, which still have 2 and 20 kind of fee structures. But if we offer you this transparent ability to pick your own investments, the cost ratios are minimal compared to the discretionary funds. And lastly, and Graham, this is most important of all, we give people the chance to have control over when they sell something. So rather than being a fixed life private equity fund for 7 to 10 years, or perhaps worse still, rather than being a fund that promises daily liquidity, but actually has to gate when either too many people try to sell at once, or even more perplexing at the moment, they're gated not because people are trying to sell, but because they're saying, we don't know what our assets are worth. So we can't let you liquidate because we don't know what to liquidate at. That's never going to happen on IPSX, on a listed environment, because there will always be a price at which you can trade. It might be down, because going back to this transparency point we talked about before, but it'll never be closed. So you can choose if you need your money. And we saw this with Sammy Lee selling his Shaftesbury stake to Capco a couple of weeks ago. On the face of it, he would appear to have crystallized quite a large loss when he did that compared to his average in price. But you know what? At least he was able to choose to do so and sell his shares when he wanted to. So control is the key thing that this dedicated exchange offers people that they don't have today.
Okay, I mean, so let's assume I'm the investor here, and I invested in a building that's, I don't know, Centre Point or something, for the sake of one that people will know, and I decide then that I bought it in January at such and such a price. I now decide to sell in June. how would I know that the price being quoted on the exchange is in any way an accurate reflection of what Centrepoint is now worth?
Yeah, so at the time the company IPOs, as with any IPO in the real estate sector, the prospectus will include a valuation from one of the agents. In the case, because we're a real estate exchange, we say they have to be members of our exchange. They're what we call approved valuers. They'll value and disclose in a consistent way. So you'll see what the asset is worth at IPO, and then that is refreshed every 6 months. So every 6 months, there'll be a new valuation. But importantly, in the meantime, every day that markets are trading, the price can move away from that valuation if there is a different market view on what it's worth. And that's a good thing, that's transparency. And of course, importantly, these are listed companies. They're listed companies on a London stock exchange. We're regulated by the FCA just like every other large exchange is. That means companies which list on our exchange follow the Companies Act, and importantly, that means that if there is any material new information that should be disclosed to the market, it will be. So, as with your shares in Vodafone or Lloyds Bank, the market price today reflects everything that should be in the market.
Okay, and because this is a stock market, do I have all the normal tools of a stock market available to me? For example, call and put options. Could I go short on central London offices or a central London office building and long on a new Midlands warehouse, for example?
Yeah, absolutely. You could. I mean, these are things which we as an exchange don't provide that. We don't, on day one, we're not going to have a traded options market, but we would fully expect, and we will try to ensure that there is a stock borrowing facility. And that's how investors, particularly hedge funds, usually short stock is, rather than using options, they simply borrow from someone who already owns a stock, sell that and buy it back one day in the future. Will you be able to do that on IPSX? Yeah.
Okay, and of course, one of the kind of organizations that might be attracted as well as retail investors, if we look at family offices, maybe even pension funds that might want to invest in this kind of market, one of the main things they'd be looking for is yield, which I guess now becomes, in this context, dividends. But we've seen, as a result of the pandemic, or perhaps as a convenient excuse, we've seen dividends being slashed recently by all kinds of companies, including the so-called dividend champions. So what kind of certainty could I have that this commercial property that I'm primarily buying for yield is actually going to give me some dividends on into the future, versus the board suddenly deciding to just cut the dividend for their own reasons and I'm left without the yield I expected?
Yeah, no, I mean, it has been, I mean, it's something I talk to a lot of private bank investors, family office investors, who often are looking at the world in a multi-asset sort of way. And it's really perplexing for them. Fixed income that doesn't produce any returns. And as you say, even people like Shell that have been so reliable don't produce returns. I think there are two things that are interesting about real estate in that context, Graham. First is that a lot of stabilized, low risk, sort of core plus asset strategies will enter the REIT regime. They'll do that because it makes the vehicle tax transparent. So no corporation tax is paid by the company on either income or capital gains. And that tax liability eventually arises just on the receipts that the shareholder gets. If you enter the REIT regime, there is a legal requirement to pay out at least 90% of the profits you make from the rental business. But I think also, just picking up on the point you raise about the lockdown and the pandemic, I think it's quite interesting that when you look at for any company, you look at its sort of waterfall of seniority of creditors. After tax comes rent, long before you get to distributable reserves and whether to pay dividends. So if you're worried that companies might be taking current economic circumstances as a chance to rebase dividends, if you're worried about the discretion over being paid a dividend in the future by Shell or others, not to pick on Shell. Maybe the smart thing to do is to buy equities that generate their dividend returns from the rent paid by those companies, because that's going to get paid first.
Okay, so if I'm the kind of owner of a building and I want to make the building available, presumably I don't know, I'm looking for some sort of exit, I guess. What are the kind of criteria that you look for in what you'd regard as a suitable building to go onto the exchange?
So the main criteria is we look for a certain amount of size. We guide, it's not a firm rule, but we guide that it's really for assets that are worth £50 million or more, even after leverage, so 50 million market cap or more. But actually, over the last 10 years on average, 60% of all UK real estate transactions have been for assets valued at more than 50 million, and that's around 50 billion in total a year. So 30 billion pounds worth of real estate every year trades at the right sort of value for us. In terms then of what we're looking for, we just want transparency and stabilization of the income profile, at least for our IPSX prime market, which is designed for low risk savings product. We're a venue, so I don't really sort of sit here and say we're not going to let shopping centres list on our exchange. We're only going to let offices, but not in London. That's not really our job any more than it's the job of the London Stock Exchange to say we don't want oil companies listing on our exchange anymore because they don't quite fit the ESG criteria. That's not the job of the exchange. The reality is that investors will decide. So there are clearly going to be certain types of real estate, going back to what we were discussing earlier, that investors will buy shares in, and there'll be certain types that they won't. But I think it's safe to say that what we want is the big trophy assets is what we're going to see on IPSX. And that's really exciting because at the moment, those can only be bought by the very largest institutions. And you mentioned Centrepoint as an example earlier on. If that were a single multi-100 million pound building listed on IPSX, everybody who catches the tube to Tottenham Court Road on a normal working day and walks past it could walk past it and feel that they own a little bit of it. You only need a few £100 rather than a few £100 million to buy it. So that's what we want to achieve with IPSX.
Okay, and what happens to, again, coming back to my scenario where I own the building, obviously I've got, other banks or institutions behind me, and they've perhaps got a first legal charge on the building. So how does something like that get dealt with in the context of me effectively floating it on the stock market?
So what happens is the asset would be put into a corporate structure. Often these very large assets already are. But if it's not, it would be put into a corporate structure, and then shares in that corporate structure would be sold. That company can have leverage at the corporate level, or indeed the asset it owns can have a charge over it. There is room for leverage still to be on these assets. So it doesn't really change the way the asset needs to be held. The big difference would be, Graham, that if you were the owner of a building and you felt like you might want to sell, say, for example, half of it, what you would do is you would put the whole building into the company and you would keep half of the shares in the company that then owns the building. That would be the main difference you'd notice.
Okay, so the mechanism's there, and so I guess when you look to the next couple of years after launch, what do you see as the kind of mix of sort of retail versus institutional investors that would be using the platform?
Well, that's a great question. I think that as I look at the investor world today, I tend to split it down into categories. Some of whom are already active buying shares in REITs. Some of whom aren't. Some of whom don't buy real estate at all because it's not listed. I think of defined contribution pension schemes, for example, who want to increase their exposure to real estate materially over the next 10 years. You know, anything like a factor of 20, you see forecasts. But they need daily pricing. And they've avoided private equity and private equity real estate. And over the last 10 years, at times we're very frustrated about the illiquidity premium that they're not being able to access. So there's also. So, but I think you're right. Your question is retail in all its forms, whether it's from the clients of Equinity and Interactive Investor, Share Center, platforms like that, through to the very high net worth clients of JP Morgan Private Bank or Brewin Dolphin. Retail, as in they're investing their own money, that will be a very high proportion of what we do. Anything up to half, slightly more of the register, I think, will go to that, because they're the people who, at the moment, simply don't have the chance to buy pieces of direct real estate of the kind of quality that they want to own.
So I guess you've got a bit of work to do educating financial advisors and private banks and platforms about the existence of and the benefits of this new market.
Yeah, and I mean, look, that's a perpetual job. It's like sort of painting the Forth Bridge. We have spent a lot of time doing that over the last 12 months, but we'll never stop doing that, because, I mean, literally the addressable investor universe is everyone. So we will never stop doing that. I think what will be a big breakthrough for us now will be that for all the people I've spent my time talking to about the idea of this, now as we start to bring out the first deals that you can invest in, that will really bring it to life. I hope that over the course of this summer, everyone's going to hear about what we're doing, and everyone's going to be looking at investments on IPSX.
Okay, well, I mean, we certainly have a lot of property investors watching us. As we come to the end of our time together, Roger, what's your kind of steer that you would give them on the way you see at least the commercial property space going in the next few years? Are there any particular opportunities you'd identify that people should take a closer look at? Anything to avoid? You know, what's your kind of top tips for commercial property investing over the 2020s?
Well, I think it's about trying to think about picking up on some of these trends we were talking about earlier on. So, you know, I think people will still use offices, but perhaps in a different way. We may well see a rise in regional offices at the expense of the, you know, monolithic great big towers in London. I think that people will still use retail, but the only places that people are going to want to actually go and shop will be the very best experiential places. I mean, you probably saw this week on the news the queues outside Nike Town in Oxford Street. That, or the Apple store, people will go to. But a lot of shops people won't feel the need to now, because they can shop online. And of course, I think the political backdrop of the last few months will mean that government support, public sector support for assisted living and care homes, for addressing the housing shortage, I think that will be a big area. So what that all boils down to is really, Graham, what we see happening in the stock markets already, these sort of beds and sheds and medical property, they are booming and trading at big premiums to NAV. But I think more generally, what I would really expect to see happening, and what I would encourage your viewers to begin to think about happening, is that to try to get away from thinking the value of this property is X or Y and I'm being asked to pay a premium or a discount to it, and to focus on transparency of cash flow. Think about who the tenants are. Think about who it is that's actually paying the rent, because that's what's going to drive your dividends. Think about how secure that is. So really it's about trying to look at transparent, long, strong, robust cash flows. That's the real trick today.
And that is always the key valuation metric in commercial property, isn't it? So thanks very much for joining us today. Roger Clarke, great to meet you, and all the best with your new venture.
Thanks very much, Graham. Goodbye, everyone.